And this week's question is all about how to uncover ETFs that are focused on top performing areas of the broader markets. So first up here again with those news, we did see the yield on that 10-year treasury. It fell below that key 4% level. A lot of that having to do with tamer than anticipated inflation data. The consumer price index did come in a little bit hotter than expected. That's that core number that strips out energy and food pricing. And however, upon closer examination, annually, year over year, we are seeing a decline. Also, producer price index, another key inflation data, did fall for the third month in a row. So that helped settle that yield on that 10-year treasury to a level that certainly is more acceptable, particularly for growth stocks that outperformed. Next week, December retail sales data as well as industrial production will due to be reported. We're also going to see a continuation of the beginning of earnings season. And also of note is that it is a holiday shortened period next week, with Monday being a holiday for the markets. So from here, let's take a look at where did the markets close for the week. A nice 1.8% gain, which helped keep this index in a nice uptrend with that RSI above 50, likewise with that MACD. And we can see that the S&P closed back above this 10-day simple moving average, again in a nice confirmed uptrend. From here, we're going to take a look at the underlying 11 sectors in the S&P 500. This is a 2-month daily price chart view. I've added an RSI indicator and sorted these sectors in descending order. What we're looking here for is where is that relative outperformance that's taking place in the markets, all with an eye toward helping you uncover that so that you can then participate. So up here in this upper left quartile are those stronger sectors. It's not going to be strictly performance-based because healthcare is up here at the forefront, but it was up 1% relative to the 1.8% on the S&P. It is, however, in a very nice confirmed uptrend, and this period last week where it relatively underperformed was necessary given the fact that the group has had such an extensive move and was in an overbought position. Next up, Communication Services, XLC, and this was an outperforming area, up 2.5%. A number of internet-related stocks, such as Meta Platforms, on the move higher. Alphabet also far outpacing the broader markets, helping this group remain in a very solid uptrend. Next up, we can see that some of these more defensive areas are up here at the forefront. However, we can also note that their uptrending phase is also in place as well, with staples finding support above this 10-day simple moving average. A lot of that having to do with some underlying companies in this space that are really coming out with some decent earnings and outlooks as well. Technology, top performer, 4.4% gain, and this is certainly relative to the prior week when it was down 4.5%. So in essence, we really regained that pullback that took place the first week of this month, and we do still have further potential upside before really regaining it. More importantly is we now have those metrics by way of momentum in positive territory, RSI above 50 trending higher, and that MACD above 50 as well. Good to see these leadership areas coming back into play. Moving along, also we want to be aware of some of these weaker areas. Financials were underperformers, down about 0.5% as we move through. I will share with you one of the sub-industry groupings that pulled financials lower, having everything to do with the release of mixed earnings reports. Also down here in this lower quartile, again, this is going to be your weaker areas, your weaker sectors. XLY is down here, up 0.8% for the week, but a lot of this deterioration having to do with heavyweight Tesla, down almost 8%. Other areas of retail as we move through, I'll share with you, were also suffered a bit. Again, we do have that retail sales numbers next week, so we'll see how they perform as it relates to earnings and outlook. Moving along here, I did want to share with you some of these sub-industry grouping. I use ETFs that I find very helpful as far as finding out within these given sectors which areas are outperforming. Again, 2-month daily price chart view. And up here in the forefront is IHI. This is the medical devices ETF, and it was up almost 4% last week. A real outperformer as we are seeing underlying companies within this space either move along clinical trials or perhaps they are getting closer to FDA approval for their devices, but in the end, this group is in a very nice confirmed uptrend. I do have a stock on my MEM Edge report that is among those outperformers. Would love for you to pick up on that by using the link below to trial my report for 4 weeks. Also, as we take a look at these groupings, you can see this is Home Builders ETF XHB. The group was up over 2%, up above this 21-day simple moving average, RSI above 50, and likewise with that MACD. So the group was able to regain its earlier uptrend from last year. A lot of that having to do with reduced interest rates. And by way of that 10-year, we talked about the decline in the yield. Further along, we can take a look at semiconductors, and while they were an outperforming group, up almost 3% for the week, I did want to point out that they did not regain the deterioration or the decline that was experienced the prior week. So this group, while there are clear-cut outperformers, NVIDIA was up 11.5%. It's not a group-wide participation that's shaping up. Next week, TSN, Taiwan Semi, is due to report their earnings, and that's anticipated to shed further light on the overall strength within this group. Another area we can take a look at, I talked about financials not faring particularly well last week, and a lot of the negative or declining side had to do with KRE, which is the regional banking ETF, down 2.6%. These bank stocks are the first to begin reporting their earnings, and as mentioned, we did see mixed results with names such as Wells Fargo and Bank of America declining, while Citigroup did increase. So again, these companies, as they report, it's going to be all about not only their fourth quarter earnings, but their outlook going forward. And again, it was quite mixed. So as we take a look here, I also did want to point out XRT. This is a retail ETF, the S&P 500 retail ETF, and it did pull back again last week. We now have a negative RSI. That retail sales data next week could be critical relative to whether this industry group is able to regain its uptrend. These retailers do not begin reporting until the very end of earnings season, so we're still a good 2 months out before those earnings could really kick in and help this group regain its uptrend. From here, I mentioned a viewer question of the week, and it has everything to do with utilizing ETFs as a way to embrace and participate in strength in a particular area, as opposed to drilling down and having to uncover those key stocks. What I'm sharing with you now is what I'm calling my ETF tracker. I have a number of ETFs that I use to stay on top of performance within the broader markets, both on a daily and a weekly basis. What I've done here with these ETFs is, again, added that RSI and sorted these ETFs in descending order. I'll go ahead and share with you quickly another view that you can very easily utilize regularly, and that is quite simply a daily summary. And you'll see, for instance, today, natural gas, uranium, gold miners, and silvers up here at the forefront. Down here as the weakest are airlines, and that JETS is the ETF all about Delta Airlines coming out with poor numbers. More importantly, a really poor or weak outlook for this year. So again, that RSI in descending order. And let's just take a quick look at some of these performers up here that are, again, showing relative strength, but it's not whippy. It's not going to be a 1 week based relative outperformer. So up here at the forefront is an ETF SHY. This is the 1 to 3 year Treasury bond ETF. And as interest rates decline, you will see these bond funds improve. And we are seeing just that. The idea behind this is the fact that you will notice different items or different evolutions shaping up in the market. And these are great ways to uncover how you can participate. Moving along, we talked about uranium being a top performer, certainly today with the gap up, but overall for the week. This is URA, and the ETF has been in an uptrend. It's all about potential reduced supply amid continued strong demand. Kazakhstan, the world's largest uranium producer, talked about they are lowering their outlook for their production because they're unable to obtain sulfuric acid, which is a key ingredient. So we are seeing a nice advance here, super high volume. We could anticipate clearly further upside in URA. Also, we talked about nat gas. You can see it's continuing to reverse its downtrend, sitting up here at 6.8 above each of its key moving average. A bit overbought at this time, but again, nice high volume pointing to further near-term potential upside. As we move through, another bond-related fund, IEI, this is the 3 to 7 year Treasury bond, but very much that same principle. As interest rates decline, you will see these overall bond funds continue to gain. From here, rather than go through the entire list, I'll share with you a couple of other areas that are outside of the U.S. And first up here is the First Trust India Nifty 50 equal weighted. India's economy has been in a growth mode, and hence their market. What I wanted to point out today is a gap up and a potential another leg up after a 3-week period of consolidation. The company is seeing consumer and industrial demand increase amid government spending, which is helping to propel their economy higher. Also, another ETF that we can take a quick look at, and many of you, if you were watching headline news throughout the week, would be aware that Japan's market hit a new high. This is DXJ, the Wisdom Tree Japan Hedged Fund. And in this case, a lot of factors contributing to this. Number one is a weaker yen. You're seeing dollars moving into Japan's markets, a lot having to do with strong earnings among their companies. Also, Japan does have lower interest rates, and we are seeing earnings growth come out of their current period of deflation. Also, last up, this gap up or this move this week had everything to do with a report from Japan that they are having or experiencing a weak labor market, which, as we know, is what the Federal Reserve is on the prowl for as a way to reduce inflation. That's it for this week, everyone. Enjoy the long weekend. I'm going to look for you again here next Friday.